David Kudla, he's the founder, CEO, and CIO of Mainstay Capital Management. He joins us. We love getting his perspective. David, again, if after the year we all had in 2022, whether you're in equities or fixed income, you really got slammed. Maybe that 4.63% in the 2-year Treasury, that's looking pretty good here. But you're an active manager. You can't do that, can you? So how are you thinking about positioning in 2023?
Well, we are an active manager, and that's why, cash or cash-like investments with that kind of yield make sense right now for part of our portfolio. We don't really ever want to be all in cash, except maybe for our most conservative portfolio strategies. But cash now, cash was dead money just a couple of years ago, and now it's got a yield to it. So it can be an active part of a asset allocation strategy.
What's your take, David? And by the way, good morning. Thanks for joining us. What's your take on the inflation picture right now? We just got PPI in hotter than expected. CPI came in hotter than expected. Every Fed speaker this week has been saying, we may need to raise rates more than previously anticipated. And today we heard from Loretta Mester of the Cleveland Fed saying she may have preferred to go for 50 last time rather than 25.
Yeah, and jobless claims had a downside surprise as well. So everything pointing in the direction of the Fed being higher for longer, along with Loretta Mester's comments. So, with the latest economic data we have, it does point to higher for longer. But, we'll see. We know that core goods has been coming down steadily. Services has been the stickier side of inflation and probably will be for some time. But this latest economic data certainly points to higher for longer. And for those looking for a pivot later this year, less of a chance of seeing that.
So what does that mean? Does it change your investment strategy? Because a lot of people were betting, the Fed's not even going to go to 5% on the real rate. Obviously, the upper end, maybe they would hit. But now it looks like 5.25 or even 5.50.
Yeah, I think, it's interesting. If you look back a year ago and other periods where we've had this almost perfect inverse correlation of the NASDAQ 100 to the 10-year, we're not seeing that now. The NASDAQ has rallied since the beginning of the year with rates moving flat up or down, and we're seeing really a stock market that's probably still has some hopium in it for that pivot later this year. But we also know there are companies out there that are they are cutting jobs. They are doing things that Wall Street likes to see. But we think that it makes sense to stay defensive in this environment. We don't want to be out of growth stocks. Certainly, that's where the action has been here in the early part of the year. But as we look forward into later this year, we may be seeing what we expected to be a poor first half and a better second half. We're getting that better half right now, at least for the first month and a half of the year.
Hey, David, we're literally exactly 80% of the way through earnings for this cycle. Got sales growth a little over 5%, but earnings growth negative 2.2%. So definitely some margin pressure there. Do you think, or how much earnings risk, if any, do you think is still in this marketplace? Because that could continue to be a headwind.
Yeah, it's still there. But the stock market is liquidity junkie. It's really, and we're seeing that today, right? We're seeing that the stock market is very much cares about what the Fed is going to do, not ignoring earnings. We're seeing the stock market react to earnings on an individual basis, but it's still like in October more, or in the last earnings season, more about the Fed than earnings.
So given that, as Matt pointed out, the market's kind of maybe taken up its expectation for where the Fed may go on rates. Given that uncertainty, is there any areas, how are you thinking about the market? Are you still defensive given that uncertainty that is the Fed?
Well, what we're doing, what we're looking abroad, and we look at Europe that just a few months ago, 3 or 4 months ago, was expected to have a worse recession than the U.S. because of the energy crunch in Europe. Now they've had a warmer winter than usual. They have a surplus of natural gas going into the off season, and we look at Asia. Except for the current tension with China reopening, that's not just good for the world in terms of being a global growth engine, but especially good for the Asia region. So when we look overseas, that's where we really see opportunity in equities and in debt and global bonds, because we expect further weakness in the dollar, and then you get a benefit of the currency exchange rate and rates that we do think eventually come down.
Absolutely. All right, David Kudla, founder of Mainstay Capital Management, joining us.